All right. Hi, everyone. Thanks for joining. I'm Alex Melberg with KO Law. We're glad to be co-hosting today's webinar with GLC Advisors. As folks are dialing in, I wanted to share a few housekeeping logistical reminders. The webinar will be recorded and we will provide that after to webinar registrants and attendees. We are reserving time at the end for Q&A, so you can use the Q&A button at the bottom of your screen if you have questions to submit. If we don't get to your question, we will be sharing contact info for the speakers as well at the end. And today we will be covering all things M&A. So we'll be covering alignment of timing and key factors underpinning transaction success, M&A preparedness, and M&A market outlook. All right, thanks everyone for joining us, and I'll kick it over to you, Jen, to get started.
Sure. So before we dive into the substance of today's webinar, Dave and I are both going to give a little bit of background about our respective firms. I'm a corporate partner here at KO Law. KO is a corporate law boutique, which means we really service the needs of businesses. For us, that means we have three practice groups. One is corporate and transactional, and that's what I do. So that's any sort of debt or equity financing, and the subject matter of today's webinar, M&A. We do probably 70% sell-side M&A and 30% buy-side M&A, and we cover a range of industries within that practice, including software and SaaS, healthcare and life sciences, CPG, among others. We have two other practice groups I'll mention briefly. One is our operational, commercial, and technology contracts group, and they help companies with all of the day-to-day agreements that they need in running a business. So think any sort of, customer agreement or master services agreement to a lease. And then we have our data privacy and security group, and that group helps companies comply with the CCPA, among other regulations, and helps companies with terms of services and privacy policies. And so, when we're helping businesses, we can usually cover about 90% of what a business needs, and then are specializing in those transactional events. David, do you want to give a little overview of GLC?
Yeah, great. Hi, everybody. I'm David Bluth. I'm a managing director with GLC Advisors. I help co-lead our technology group and have spent the entirety of my career really around M&A and capital raising advisory for middle market technology businesses, predominantly software, tech services, tech-enabled services, and the like. In terms of a quick overview on GLC, so we are a national investment banking boutique. We have close to 70 investment bankers across 4 offices, and provide and really focus on advisory around M&A, restructuring and capitalization, financial and debt advisory, and growth financings, generally institutional capital raising. In terms of how we go to market, we do bring deep sector expertise and have specific industry coverage groups along the sectors kind of outlined on the bottom left of this slide: business services, consumer retail, industrials, gaming, healthcare, technology, among others. So we work across the country and have clients internationally as well. From an M&A perspective, we really are sell-side M&A bankers. We spend 95% of our time on the sell side. All right, so that wraps up the KO and GLC commercial. So to jump into kind of today's conversation and topic, we wanted to start with timing. And this slide is all around when we're having conversations with founders and business owners around when is the right time to sell in order to realize success. We normally have a discussion around this framework, where it really revolves around the alignment of three core factors. And Jen and I will touch on each of these in the slides that follow, but it's macro considerations, internal company considerations, and shareholder considerations. And in our view, all of these need to align in order to create the right pretenses to maximize valuation, have a number of alternatives and options available for owners and sellers, whether it's different transaction types, different buyers, investors, et cetera, and to also ensure that there's a high certainty of closing the transaction. So with that, why don't we talk macro considerations first? And these are things, really outside of the company or seller's control. So things like domestic and global stability. What's the geopolitical climate and environment? Capital market conditions. So state of public equity markets, are the stock markets performing both domestically and globally, or the state of the M&A markets and financing markets. Interest rates and capital availability. So this touches on cost of capital, how much dry powder is on the sidelines, but not only capital availability, and we'll talk about the state of today's markets here later on, but what is the market psychology and appetite to deploy that capital on behalf of buyers and investors. And then finally, industry and or end market considerations. So this is getting at the end markets that you sell or that your business serves, or the markets that you're operating in. So for instance, would be, if you're a technology product or service provider, touching the residential real estate market, that market's been under pressure over the last, year plus, and has made often for a more challenging environment for companies servicing that market. There's shrinking demand for those companies providing services to that market. That would be an example. And so to wrap up how this macro considerations fits into the broader framework of the prior slide, you can have a business that is ready to sell, or you as the seller believe you're ready to sell. You have a really nice company, but the macro considerations are such that M&A markets are not robust, or financing markets are tight, and there's not the same level of reception that in a healthier macro environment that would otherwise be available to your business. So of course, that would be key to realizing success. With that, Jen, why don't you kick us off on internal considerations?
Yeah, so in addition to macro considerations, and another big factor that needs to line up is internal company considerations. And this is just, broadly, how is the company doing, and are they, and is it prepared to enter into an exit process? And I'd say under this umbrella, there are a number of factors to consider, but David and I have listed some of the key ones here, and so we can talk through these briefly. One is, key customer relationships, including customer concentration. So typically, acquirers are looking to make sure that you have your key customer relationships nailed down. And this is both from I would say a commercial or relationship point of view, and acquirers will often, in fact, later in the process, do calls with key customers to make sure that, in fact, the relationship is solid. But also from a contracting and legal point of view. And as you might suspect, the higher the customer concentration is, meaning the more of your business is concentrated in one or a few customers, the more an acquirer is going to care about those relationships. And so, there certainly is a tipping point, and I'll turn it over to David here in a second to talk about what that might be, where if too much of your business is in one, with one customer, that could be considered simply like too high risk, because if something happens with that customer, the business itself is in jeopardy. But, typically this is manageable, but a company should absolutely expect that, like, as customer concentration increases, there is more scrutiny. And, so from a legal perspective, if you have a business with higher customer concentration, you are especially going to want to make sure those contracts with those customers are buttoned up prior to entering into an exit process. And so, that means both things like, if you have a recurring revenue model, making sure that that is reflected in the contract and it has appropriate extensions, but also, that just overall the risk allocation in the contract is appropriately divided. And then, I mean, David, like, where do you typically tell companies, like, okay, if you have this much customer concentration, you're like likely to get a little bit of side-eye or something?
Yeah, I think when you start having concentration, in your top customer, something exceeding 20%, it's going to draw a lot of attention from buyers or investors to ensure that that relationship's going to be sticky. There's a change of control that, of course, that's not of risk. There's, of course, other ways to define that. If your top five customers account for north of 50% of your revenue, you know, generally that will have the same considerations attached to it. Where the exceptions lie, there are certain industries, of course, where you're more predisposed to large kind of customer concentration, but otherwise, if you're dealing with that, everything Jen said in terms of doing everything you can ahead of a sale to ensure that that customer or customers are secure is going to be critical, to putting your best foot forward.
Yeah. And then, similarly to key customer relationships, there are key vendor relationships. For a typical SaaS company, this may be nothing, right? You may just have sort of off the shelf, whatever, Excel or Microsoft Word or, things that you use. And there really are no key vendor relationships, but that could be very different if you're looking at a hardware company or if you're looking at, a consumer company. And there are key vendor and or supply relationships. Those will be scrutinized similar to key customer relationships. Those contracts, you'll want to make sure they're buttoned up. The relationships an acquirer will go and vet from both a legal and a relationships, point of view. And so, should think about those similarly. I will say, especially like in a hardware or any sort of like product company, if there is something that you get from a sole source supplier, and you do not have a backup, you don't have a second source that you can go to if something on that supply side fails, that is something, again, that will, an acquirer will really like hone in on and look at and say, okay, like that there's no plan B here. So this needs to be really buttoned up. And also you should probably have a plan B. So that's something to think about if you have sort of key vendor and or supply relationships. This next one, key developments in product. Um, you know, that really means like, what are the different products in your company? What are the life cycles of those products? I'll give an example here. In the past, I've had a client where, they had both a legacy line of products that they offered, and also they had this new product offering that was coming out and was getting a ton of traction. And everybody was really excited about it. And they started talking to, a number of investment bankers, and, through those conversations, really found out that the future was really this new line. It was really this like new product offering. And that's what acquirers were going to be interested in. And this legacy one, although it made up a substantial portion of their business, was A, kind of like naturally fading out, and B, something that was like unlikely that acquirers were going to be interested in. So the advice they got across the board was, let's wait a year. You should focus your time and energy into new product line. You should really make sure you get customers signed up that. You should start devoting internal resources to new product line. And, you should devote basically as little attention as possible to original product line, because that's going to be viewed as a kicker. It's not going to be viewed as something that's going to generate its own value. And so, if you have sort of competing product lines and maybe one is legacy and one is new, or there's a million different examples, but kind of where those are might affect the timing of when you go to market, because the original, the advice that you may get is, hey, you really should be focusing on this one part of your company for a while and giving it some attention before you enter into the market. David, I don't know if you have any comments on that aside from what I said on that.
No, I was going to cite a similar type of example. Some of this boils down to whether it's from new products coming out or your state of financials. It's what's in the rear view versus what's on the come. And if too much is weighted on the come, you're unlikely in most instances to reap the full kind of rewards of that opportunity. That might get someone excited in pursuing your deal, but you're unlikely to receive maybe the full value or upfront kind of cash consideration and value that you personally might be ascribing to that opportunity.
Sorry, I had an ambulance going by and still do. 1 second. Okay. Management team, I think we'll talk about this one also in connection with the next slide, but you do want to start thinking about your management team. And if it is a management team that an acquirer is likely to want to keep on, or is it a management team that to an acquirer is going to feel sort of early stage, not sophisticated enough, and they are going to have to, in large part, replace. And, and another thing to think about, and we'll touch on this on the next slide as well, is like also, what is your own goal, right? A lot of founders are sort of very happy with the model of, I'll take some off the table, I'll roll some equity over, I will keep working with the new company. And if there's a second exit down the line, then great. That's amazing. And that fits with what I want. Other founders and maybe even other management teams are sort of have the feeling of, yes, when this happens, I want to be done. I'm retiring. I'm happy to help transition, but you should not expect my participation for any sort of long-term period after. And understanding, that goal and being upfront about it from the get-go, I think is really important. David, anything to add on management team? Then I'll let you cover stated company financials as well.
No, I think it's just understanding kind of your strengths, weaknesses, areas that could be augmented. What are key positions you might need? It's one thing getting your business to, an exit event today, but, if you're doing a private equity deal, for instance, they're looking, well, how do you triple, or 5x the size of the company in its next phase? And sometimes, the leadership requirements or the types of folks around the executive table will change over time. So I think part of it's also having some awareness around those dynamics as you think about your team entering a process and who you're going to put forward alongside you to represent the company in its future.
That's right. Wait, and then did you want to say anything else about stated company financials?
I think we can keep this one quick. I mean, on financials, this has a lot to do with, are you really ready to be sold? And are you really ready for the deep scrutiny that comes with due diligence, specifically around accounting and the financial performance of the business? And so this has to do with record keeping, the cleanliness of your data, and, are you keeping your books in accordance with GAAP? What's the trending look like? How does that kind of correlate or trend historically in relation to what you're projecting for the future? Those are things that, of course, any buyer or investor will go to great lengths to diligence, and is really critical, for sellers, founders, owners, to be on top of ahead of a process.
And David, how often are you recommending that companies on their own get a quality of earnings report versus waiting and letting the buyer do that as part of their diligence?
We recommend it almost every time without exception. Where we are not recommending it, there's some very specific kind of situational context that normally informs our view as to why that would otherwise not be necessary. If you are to consider any sort of broad marketing process where you're trying to align multiple, counterparties on the same timeline in an organized process, pretty much without exception, we would say you need to do a quality of earnings, even though the buyer is going to do the same work. And one example, and there's a multitude of reasons why we feel so strongly about that. We do a ton of founder representation. We also work with private equity firms in the sale of their portfolio companies. You will not encounter a sponsor, no matter the size, sponsor being a private equity firm, that will not do a quality of earnings on their own portfolio companies before taking them to market. And these are businesses where the reporting is, tip top. There are no surprises to be found. In 100% of the time, they are going to go through that exercise.
Yeah, that's my experience as well. Okay, so looking at the next slide, shareholder considerations. So this is different than, is the company ready? This is really, are the sellers and the owners of the business ready to do this? Right? Are they ready to exit? Does it feel like it, aligns with all of these things? The first being the life stage of the shareholder, and is this a business that they've had for a long time and they're going to sell it and they're going to retire and that's it? Is this sort of, what I'll call like a professional entrepreneur who, forms businesses, grows businesses, sells businesses, and then is going to be on to the next. So there's sort of a lot to think about in terms of, are you actually ready to let go? And I think that that's a hard enough decision when it's a single shareholder, but oftentimes companies have, other shareholders and other stakeholders. And so, if there are multiple sellers, I think it's, also having that conversation, from the beginning and seeing if everybody is on the same page. Of course, the best practice is to make sure that, if there are multiple sellers, making sure that everybody is on the same page, everybody is ready to sell the company. That's not to say that situations don't happen where maybe a majority of the shareholders are ready to sell, but maybe somebody isn't. And then you're really getting into, number one, what do your legal documents say about who has to agree to a sale before it happens? But then, in addition to thinking through that, you want to think through, okay, even if we can technically sort of quote unquote force a sale with the majority of shareholders, how is a potential acquirer going to react to that dynamic, and how much of a turnoff is it going to be if there's one seller who is just saying, no, I'm not on board, I'm not going to sign anything, I'm not going to participate, I'm not going to cooperate, right? So sort of separate from what are the, legal strategies to get you to a yes, if not everybody is on board, there is also the optics and the dynamics that can create with a buyer. And I will tell you, there are these things in many shareholder agreements called drag-alongs, which is essentially the idea that if enough people agree, the people who don't agree can be drug along and you can do the sale anyways. And there is a reason that those are hardly ever used. And it's because it's messy and it's a turnoff to acquirers. So really making sure that to the extent that you can, you are getting everybody on the same page beforehand and or having serious conversations with your advisors if you don't think that's going to be possible, is really helpful. I also think considering and having frank discussions about your objectives in the exit of your business, is really helpful up front. I mean, I think it's natural to think, well, my objective is to get as much money for this business as possible, but that's certainly not all founders' objectives, right? Some founders are very culture centered and they care very much about like the home that their company lands in. They want to make sure that the buyer sort of has the same vision they do, either around the direction of their business or around how they treat employees of the business, and sometimes both. So really, having those discussions up front and thinking through what is important to you other than, of course, the top line purchase price, and how much do those other factors matter, and understanding that up front will help everybody. Well, it'll help your attorney, it will help your investment banker sort of vet and think through what are the things that need to happen in this deal for it to be a success and for it to get to the finish line. I think you want to have, yes, upfront conversations about, valuation expectations right from the get go, and sort of think through, okay, what do I have to have? What would be nice to have, so that everybody has appropriate metrics to work within. Something that we always think through is, and try to advise people is that a number of deals can have what's called an earnout component. And that is where you're not getting upfront purchase price. You are instead, having to meet certain revenue or EBITDA goals and milestones after the sale in order to get the rest of the purchase price. And I've seen the most discontent when people really feel like, okay, well, I wouldn't have done the deal if I didn't know I was going to get that. Like, you should always be treating any sort of contingent purchase price as an unknown and as gravy. And there seems to be, in my experience, a lot of heartburn when people are really relying on that part of it coming in, because once you have sold your business, for the most part, have lost control of your business. And there are a number of factors that mean you may or may not make those revenue and EBITDA milestones going forward. So, I would definitely have discussions, if that's going to likely be a component of the deal, about, how important that is and how you're viewing it. And of course, there are things that, like a David or an I could do to help protect and make sure that you have the best shot at receiving that additional consideration, but you don't want to be so tied to it that I think it colors the whole deal. And then alignment of shareholders, we've definitely talked about this. I would just add that can be broader than shareholders. It really can be other stakeholders in the company. We've had a client where, it was a family relationship, and one family member owned the vast majority of the business. And so definitely had the right, to sell the business, but another family member sort of felt like they didn't want to do that. They wanted to keep it family owned. And, the family member who wanted to sell certainly had the right to do it, and just sort of decided, well, I've got the right to do it. I'm going to do it. I'm going to move forward. And then, as with many family dynamics, it got messy, and the smaller shareholder, got signatures from the entire engineering team saying, listen, we will resign if you sell the company. And that was really sort of the backbone of the company. And, it killed the deal. And yes, that was a place where legally, the initial shareholder had the right for sure to sell the business. But if he lost his entire support team in doing so, that wasn't going to be attractive to a buyer. And so, I would, always and do encourage people to really think through, like, is this the time? Who else has a say? Who else can make a sway? And are we all on the same page? David, anything to add under shareholder considerations?
That was a great overview. I think the only thing I would add, and many of your remarks were getting to this, at the end of the day, deal making becomes very emotional for founders and the shareholders. And so being in front of alignment and understanding objectives and understanding where there's alignment and where there's not perfect alignment, and being on top of that early is really important to navigating it. Things become much more emotional when there's a pile of money sitting on the table. So if you haven't broached some more of the challenging conversations that need to take place, or you haven't, made sure there's fulsome alignment around what we're solving for, of course, that can lead to a lot of wasted time and conflict internally. So getting that out of the way earlier will help ensure that you're deriving the right outcome after going through the process. All right, so M&A preparedness. So when the time is right, how do you prepare to sell your business? So as you can imagine, preparedness is multifaceted. There's a lot that goes into it because there's a lot that goes into selling a business. So Jen and I will kind of tick through each of these topics, everything from choosing advisors, who are the right advisors, what's crafting messaging and positioning really mean in the context of preparedness, completing diligence, and then, of course, confidentiality considerations. So choosing advisors. As you can imagine, going through an M&A process, selling your business is exhaustive. And what you're going to encounter on the other side of the table, so whether it's a strategic buyer or a financial buyer, private equity firm, is the level of scrutiny applied to your business is really intensive. And you're going to be dealing with people who are very sophisticated, savvy deal makers, who are professional deal makers. And the reality is you're going to want folks on your side of the table, on your team, advocating for your interest, who have the proper and requisite knowledge, expertise, and judgment to navigate a process that we always advise founders. There's many, deal issues that, are specific to the company that we could anticipate or get in front of. There's always 3 to 5 issues, though, unique to every deal that are very challenging to anticipate and often cannot be anticipated. And so you're going to want people who have the right kind of background and track record to help navigate through the sticky points, the challenging points in a deal. Of course, selecting the right type of advisors, you're going to want people who are sophisticated, knowledgeable. You don't have to teach them about the fundamentals of your company. They can bring the right network of buyers or investors to the table. They understand the legal nuances and issues that are going to be important to your industry and your business. And then you're going to be spending a lot of time with them. So chemistry and trust, of course, are critical. Running an M&A process typically takes somewhere between 5, 7 to 8 months if you're doing a broader process, and you spend a lot of time. So having chemistry and being with people that you feel comfortable with working with is critical as well. We advise, the right team has an investment banker, really strong M&A legal counsel, really strong accountants and tax advisors. And Jen already brought up, the importance of sell side quality of earnings. So that's a accounting financial exercise. But those are typically the deal teams that we are surrounding our clients with and working hand in hand with Jen in M&A attorneys to put the best foot forward on behalf of clients to get you really ready to take your story to market and then navigate the deal as you get deeper into the process. In terms of timing of choosing advisors, the high kind of level remark or reaction to that is you should be getting this organized before you're entertaining serious conversations with buyers or investors. And we know it's very commonplace, obviously, to be called on as founders, entrepreneurs. You receive a lot of calls from private equity firms, other buyers, before you're really sharing a high level or detailed level of information, really trying to see what your business might be worth. You're best served getting your team in place before you're leaning too far into that. So that, Jen, any other remarks you'd add to that before we move on?
No, I mean, yeah, I totally agree with that. And, often, even if you have sort of one connection to an advisor who you think is solid and you're sort of struggling with like, oh, well, how would I even find an investment banker? How would I even find an M&A attorney? I would say that, if you find an advisor or, anyone on that list of, of professionals that you really trust, they will often have, all sorts of recommendations for you, and, can give you two or three. And then I would just add a lot of it is fit. Like, a deal, as David mentioned, can get emotional, and it's also very time intensive. Like, when you are actually getting the deal done, you are going to be spending a lot of time, especially with your M&A attorney and your investment banker. And so sometimes it's really as simple as like, you want someone that you jive with and you're not going to mind spending a ton of time on the phone with and talking through matters, and somebody you feel comfortable asking questions to. And I think that, in addition to, of course, like, really subject matter and industry expertise, feeling like, okay, I fit with this person and we're going to make a good team, cannot be overstated.
All right, so crafting, messaging, and positioning, this really revolves around like what story are you taking to market? What is the thematic messaging that you're putting out there in marketing materials and communications that are taking place with buyers or investors who are evaluating your business? So positioning often revolves around, the company's journey, what you've built, the financial performance, really understanding why now is the right time to exit, what is motivating, the founder, management, or sellers to seek going to market, and critically, what makes your company unique. And this is all around, metrics, but why is it? And think critically about why would someone want to buy your business? And not only would they want to buy your business, what do they need to understand in order to pay a premium for your business? Those are the things that positioning strategy really tries to flesh out in communications, verbal, but as well as the kind of written materials that are part of marketing a company in a sale process. Um, Part of that, so there's articulating and conveying the story, but it's also about being in a position to dictate the story and the numbers. So what we mean by that is there's painting a story, there's talking about the growth prospects of the company and why what you do is unique and has competitive differentiation and this great value proposition. All of those statements and claims typically are supported empirically by what the data says. Like, what does the key data and metrics say about the health of your business? And how closely do you understand and manage to those metrics? So for a SaaS company, for instance, being able to clearly articulate and communicate with buyers around the various measures of retention of your business and sales efficiency metrics like LTV to CAC, CAC payback, these other things, it instills a different level of confidence with your buyer set in terms of how they perceive management's own sophistication. And it's the data they rely on and get very deep in underwriting the story and what they think the true health of your revenue stream is, what the true growth opportunity might be for your business. And what we always say, dictate the story and the numbers. That means be on top of the data, have it clean, have it tick and tie so that you're not on your heels just reacting to the deluge of buyer and investor diligence requests. You never want to be in a position where you're just sending source data and waiting for your counterparty to come back to you with a 50-page data book asking you, well, what do these trends mean in your business? And you're actually not really aware because the data's never been mined and curated in a place in a way for you to understand what it is saying and what the outputs will be. And finally, anticipate buyer investor questions and retorts. So what we always tell business owners, no business is perfect. Have a keen awareness for what the soft spots are and make an effort to anticipate what, where buyers and investors might push, where are the soft spots in the business, and what is our kind of strategy to mitigate those issues? What's our communication strategy? How do we kind of position the narrative to address, those elements of the business that could be strengthened going forward?
Okay. Completing diligence and cleanup. So this is just sort of really about preparing in advance. I mean, it is already hard enough, and it definitely is strain for business owners to both run their business, their day-to-day business, and sell the company at the same time. So the last thing you want to be doing is running the business, selling the company, and cleaning up historical issues with the business. Because if you're doing all three of those at the same time, definitely one of the balls is going to get dropped, which does not make for the most efficient process with the best outcome. And so one thing, that sellers can really do in advance is complete diligence in the cleanup before they go out to market. And, what issues come up is certainly going to be company specific and depends on the company. But, it's really having your investment banker and your M&A lawyer take a look through your files and your business before and identify through their experience what the holes are going to be. So for example, if you have a bunch of like great employees and they've been with the company for a very long time, and you think that they're great, but you've never had them sign anything and you haven't because you trust them. Well, a third party buyer is not going to have the same trust in your employees from the get-go that you do. And in fact, they're going to look for, employees having signed very specific, standard to the industry documents that employees should have signed. And so that's something that is easily, able to be cleaned up before you ever go out to market, so that it's not like, as David said, no business is perfect. There are going to be soft spots, but to the extent that you can address those beforehand easily, you definitely want to do stuff. Like, you don't want to give the buyer a laundry list of things to point to. So for example, if your employees haven't signed documents, you want to get those signed beforehand. If you have certain independent contractors who, helped contribute code or created your logo, actually those contractors own that IP unless they have signed something specifically giving it to the company. And, depending on the company and how important the IP is, it can be, it can turn into a big deal if you don't actually properly own all of that. So, going through and making sure that, things like employees, contracts, key customer contracts or supply contracts that we talked about earlier, are buttoned up and ready to be presented in a like professional and way that is going to be expected, is just going to save you so much time and energy later and allow you to focus both on making sure that the business is continuing the trajectory that you want it to for a buyer to be interested, and also allow you the time, which is going to be a lot of time, getting the transaction done. And so, I would just say it makes for a way less chaotic process if the holes, and every business has holes, can be addressed before they go to market. David, anything else to say here?
The other thing, all I would add is that the level of preparedness actually is correlated to the seller's negotiating leverage as well. So when you're really prepared and you have all the data at your fingertips and the house is in order contractually with all the details, it actually allows your banker to drive a more aggressive process and or have more process flexibility in terms of the judgment calls we make along the way in terms of what we're communicating to buyers and investors, what we are stating to them about the nature of the process and how quickly we want them to move. And then, of course, when you're really well organized, we can appropriately provide them, and we phase out how we do this, the right information we know they need to put their best foot forward from a value perspective, but also be comfortable that we know they've done the requisite work to stand behind that value. So, a high valued LOI isn't worth anything if the deal doesn't close. So the more prepared you are, the higher the likelihood you're going to make your way to the finish line without encountering unforeseen deal issues pop up as a result of diligence that is a surprise and results in either the deal going off track or of the buyer coming back to you asking for, a price concession because, something that wasn't understood is now on the table. So types of due diligence, you know, this might be self-explanatory. A huge part is, of course, financial and accounting diligence. Understanding this early is really, really critical. You don't want to be surprised late in a process that you weren't recognizing revenue correctly, or, you know, the financial statements aren't uh, reported correctly. EBITDA is not what you anticipated. Those are the most common reasons in our experience, a miss in financial performance or something servicing in financial due diligence for transactions not finding their way to the finish line and or being recut. Related is the business data and key metrics. So the level of scrutiny, especially amongst PE firms, of what data they will get into, how they will look at that data and cut it up, is really intensive. And they're going to look at your business in ways that you have likely not thought about before, or looked at, or had availability to real or resourcing to really get into the weeds in the way those investors might. So those are really critical. The first two are absolutely essential to maximizing valuation and upholding valuation.
Yeah, and then, you know, the last couple, we just talked about the third one, ensuring key assets are secure. So that's your employees, your IP, your material contracts, you know, getting those buttoned up to the extent that they are not prior to entering into a process. And then, you know, lastly, addressing any ongoing litigation or significant contingent liabilities. Yeah, so I mean, and sometimes this isn't possible that, you know, if you're in litigation, it is totally wrapped up. But, you know, a lot of times if you have the ability to settle and or, you know, close out sort of a long-standing issue, to the extent that you can do that, you know, it's nice to have it buttoned up. You know, what happens if that it's not, is that the buyer, you know, will reserve often some portion of the purchase price and or have a right to come and, you know, either claw back or receive indemnification from the seller after closing. So, you know, it's just things that you want to raise early in the process with both your investment banker and your M&A attorney if you do have ongoing litigation, and, you know, get an opinion about how it might affect the deal. And, you know, if it is sort of easily resolved, you know, how that might impact the deal and whether it's advisable to do so. Okay, and then, you know, quickly, confidentiality considerations. So, you know, usually in addition to just the sellers themselves, there are, you know, especially if there's a sophisticated management team, a small group of employees who are in the loop, you know, if not from the very beginning, then certainly early on in the process. Who can help support the company and, you know, support David and his team and us to help gather the information that will need to be gathered and presented to potential buyers. And so really thinking critically among, okay, who are the employees who are going to be in the loop, and also stressing to those select employees that, you know, it's not appropriate to talk about it broadly, that you don't want it sort of leaking out further into the company. You know, a general rule for customers, suppliers, and especially competitors, of course, is to keep a lid on, you know, any sort of external communication that you might be going through a process, you know, as a general rule. As we mentioned earlier, you know, as you get further along in the process, and typically really almost toward the very end, it is possible that a buyer will call some of your key customers. And at that point, yes, you're going to be giving them a heads up, but there's no need to give, you know, customers and suppliers a heads up right from the beginning of a process. That's something you typically want to, you know, keep confidential. And then the other thing, you know, you should be thinking about and discussing with your advisors is whether there's any really sensitive information that shouldn't be disclosed until, you know, either after a letter of intent is signed with just one party, or even, you know, in certain cases, immediately prior to signing. And so, you know, if there is something and, you know, a competitor is buying you and there's something that is like really the secret sauce of your company, and that if the deal didn't go through, this party who is thinking about buying you, despite signing an NDA and having certain confidentiality, considerations, you think would just be, so sensitive for them to have that you really don't want them to have it unless the deal is going to go through. That is something to be cognizant of, and raise, right from the beginning of the process. David, anything else on confidentiality?
I think that's a really good overview. I mean, where we have a lot of conversations with clients is this top bullet, who's in the loop from the beginning, and being really mindful of, the context of an M&A deal. M&A brings about change, whether you're looking to sell to a strategic buyer or do a deal with a private equity firm. Change is coming, and we're all human. Change creates certain level of anxiety. So be really mindful of who is in the loop. We normally advise keep it to, a pretty limited set of key leaders who are really in the know and are important to have in the know and critical to communicating your story. Because until the deal is done, you don't want to create undue kind of stress or disruption within your broader employee base. All right, finally, M&A market outlook quickly, and then we'll field some questions. So the headline here is that while, uncertainty remains, there's obviously a fair amount of geopolitical turmoil. We have an upcoming US presidential election. There's been commentary around whether we're in for a soft landing or not. The reality is we believe we're in the early innings of a kind of broader M&A market recovery. Public markets are trading at all-time highs. M&A and financing deal volumes year to date through 2024 have been picking up. We're not back to 2021 highs in terms of volume. Valuations are not the same as they were in 2021, but deals are beginning to get done. It's also a result, or largely a result, there's a tightening bid-ask spread between buyer and seller value expectations as we had been navigating, 18 plus months of choppier market conditions. Interest rates being cut, that was a positive catalyst because when you combine that with significant, private equity dry powder that sits on the sidelines today, and strategic balance sheet cash, because strategics have largely been on the sidelines too, and then LP pressures on PE funds to create liquidity and sell their own assets. Those are all things that we think are going to continue to contribute to and create some momentum for renewed and healthy in more seller favorable market conditions in 2025.
Yep. And I would just say from our point of view, we're absolutely starting to see sort of an uptick in interest and processes starting. That being said, it's not yet, nor do I think we're on the immediate horizon of like a 2021 market. Buyers are still absolutely doing their diligence, taking their time, and making sure that the businesses that they want to buy, are solid and have, good financials, good diligence, like all of the things we've talked about. We're certainly not in like a rush to close sort of environment.
All right, I'm coming back on to field some Q&A. Thank you guys so much for this discussion. Super, super helpful. One question we received was, can you discuss when to communicate to employees and generally how to handle transaction bonuses, transaction incentives for teams? I know you touched on some employee communication, but that was a follow-up.
Okay.
So
Go ahead, David.
Want me to take a swing first at employees and maybe then touch on kind of transaction incentives, et cetera. In terms of employee communication, I mean, in most instances, and of course there's exceptions to this rule, but most commonly our starting position is, keep communication only to those key leaders, as I had said before. Often, their equity holders, their executives on the C team of your business. And that should be enough to get you late enough into the process to know if you have transactable alternatives in front of you or not. In terms of then, bringing more employees into the fold, mid-level management and kind of down to rank and file. As you get deeper into final due diligence, there might be specific departmental needs like due diligence around technology and your infrastructure where you might need to reach down a layer to get the requisite expertise on board to communicate with buyers, CTO and folks like that. But otherwise, we still commonly suggest waiting until just immediately prior to close for any broad company announcement. Again, until the deal is closed, you don't have a done deal. And if you make a company-wide announcement that something's going to happen, and for whatever reason the deal gets off track, of course, that can leave you in a not wonderful, position that could be avoided.
Yeah, and I mean, and the question on transaction bonuses, I would say that, that's going to be company and even individual specific. Basically, you do want to make sure that, especially for the management team and the small group of people who are going to be in the loop, and helping you get this transaction closed, that they are appropriately incented to do so. And that may already be the case. Like if they already have sort of equity grants in some form, you may feel like, okay, we're covered. But if those equity grants have fully vested and or maybe it wasn't put into place, but you're going to need, a huge push from certain team members, to either get them on board with the transaction at all, or maybe just to properly incent the fact that this is a super intensive process and is going to require a lot of time on top of their normal job. You might want to, incent them with what's called a transaction bonus. And that's really just like an additional amount of compensation that they get at the end of the deal when the deal closes that they weren't otherwise due. And this can be set up in a number of ways. It can be set up as like a one-time payment upon close, and that's most common. It can also, if your deal has certain contingent consideration factors, like there is sort of a revenue or an EBITDA earnout, it can be set up so that part of their bonus is earned, if and when those additional payments are made to the selling company, so that even post-close, certain individuals are incented to keep working hard and keep working for the company. So yes, they are, an important and a good tool. And I think one that is, company, deal, and really even individual specific, and something that your, advisors can absolutely, help you navigate.
The only thing I would add to that is thinking through that early. As you might expect, there can be really material tax implications to the recipient, depending on how that all is structured and when it was structured in relation to consummating a transaction. So
I think we have time for one more question. This one came in and is directed to you, David. Can you share an example from your experience where selecting the right advisor made a significant difference in the outcome of an M&A transaction? Jen, I'm sure you can speak to this as well.
yeah, so I will speak to it from, recent personal example, though Jen will have seen many instances of this. Other investment bankers will all have a story for this as well. But we had a recent client. It was a vertical SaaS business, and they had been approached, as many of our prospective clients typically are, prior to having engaged us. And it got to the point where they were having these dialogues with a couple of different strategic parties while speaking with me and my team kind of on the side, and I think really considering or trying to decide whether or not they needed to hire us. And of course, the buyer was in there. You're saying, oh, you don't need an investment banker. And they ended up sending a really detailed letter of intent to this client. And it was a client that we actually had suggested you should put your head down, continue to scale up. We think the macro conditions are out of sync with our three-factor, framework, scale up, and let's market the business more broadly in a year or so, depending on market conditions. Well, this preemptive buyer came with an LOI that actually was at the threshold of acceptable transaction value for the client. And so, they debated for quite some time whether or not to hire us because their needs, at least from a headline number, would be met. But as I started digging in with them as to, well, what information have you provided to this buyer to inform the value that they're giving you? Because they're saying they can close really quickly. They're telling you everything you want to hear. There's great detail in the LOI. And so we went through it, and they had shared, they were on the 1 yard line of what's really required in terms of the data and everything else necessary to prep for a process. And they actually had provided information that, as an investment banker, pitching for someone's business, I would not have been comfortable saying, I think you're between X and Y. So, I persuaded them that let's do this right. I mean, even if we go just with this buyer, here are all the things we need to get them before you should lock arms. By the way, we are very connected with many of the other logical strategic buyers. So we ended up running a mini process, but we got them prepared and got this buyer everything they needed, and brought more bids to the table, but we doubled the enterprise value from where they started in the deal our client would have taken. And it was a combination of getting good information in their hands, but applying competitive pressure too, and letting them know that they were not the only kind of party at the table. So there was a lot that went into that, but we had many examples where, that, and then we had excellent legal counsel that helped get ahead of very specific and nuanced issues specific to this business, both from a risk allocation perspective, but also from a tax and kind of post tax consideration perspective that created meaningful dollars for the client.
Yeah, I mean, and I would agree with all of that. And I think that, it really does make a difference, when we're doing buy side work, it's, especially, and we encounter a business on the sell side that has chosen legal counsel that is, unsophisticated, or, has not done this before and is really kind of like a business attorney, but is not an M&A attorney. Yes, it can absolutely slow the entire process down. And in fact, some of the buyers that we have started working with will actually vet a seller's counsel up front. And if they don't feel like they have sort of enough experience to get the deal done in, an efficient manner, we'll suggest that a seller sort of upgrade counsel. So that absolutely happens. It does make a difference. And it is something that, buyers are paying attention to.
All right. Well, I know we are over our time. Jennifer and David, thank you so much for joining us today, for sharing such great advice. Everyone, we have their contact info on screen, and we will send out the recording afterwards along with contact info. So thanks everyone for joining.
Yeah. Thank you, everybody.
Thank you.